Hello, Internet. My name is Ryan Ingram, and there are exactly two things that stand between your foreclosure and traditional financing. The first thing that would prevent you from getting traditional financing on a foreclosure is access to the interior. So another video that I just recorded, how to find and buy a foreclosure. In that video, we discussed the three parts of the foreclosure process: the pre-foreclosure, the actual foreclosure, and then the bank-owned HUD part. In all three of those steps, so in the pre-foreclosure, you might actually have access to the interior. If you have access to the interior, then you're able to do an interior appraisal, which would qualify, or that's a requirement that the bank will need in order to approve your loan on the foreclosure. So if it's in the pre-foreclosure process and you actually know the owner or the person that's being foreclosed on, and you can get into that property, if you have their contact information, they're okay with it, if they're trying to sell it to you prior to them actually being foreclosed on, then it is possible for you to get traditional financing because you have access to the interior. When you're in the second stage of that foreclosure process, when you're in the courthouse, then there's a very, very slim chance that you possibly have access to the interior. So as it's being foreclosed, it's not really owned by the bank, it's no longer really owned by the occupant, then access to the interior is very limited. So a bank won't be able to get in there, appraise it, make sure everything's good, figure out how much work is needed, if it's livable, any of that. So since all of those are unknowns, then a bank is not going to lend you money on that property. Now, in the third stage of the process, when it's bank owned or owned by HUD, then there is a chance that you do have access to the interior. So if it's bank owned or a HUD property, then you probably have access to the interior, which means that interior appraisal could be done, which means you might be eligible for traditional financing. The second thing that might prevent you from getting traditional financing on a foreclosure is the time frame. When somebody's being foreclosed on, it happens quick. They've been receiving notices. There is a court date that's imminent. Time is essential. It is everything in the foreclosure process. So you're going to want to get this done as quickly as possible. And if you've ever purchased a home using traditional financing, you know that they are not fast. When they tell you 30 days, you can expect 60 days. When they tell you 60 days, you can expect 90 days. To all of my friends that are lenders, then I am sorry. I do not mean to speak ill of you, but you know you are slower than you say. It is a fact of life, and that's something that we all live with, which is the second reason that it is difficult to get traditional financing on a foreclosed home, because foreclosures happen fast. There's a court date. There are so many things that have to be done in a short amount of time. Traditional financing, there's just not the comfort of time. In the pre-foreclosure part of the process, then everything is a little bit unknown. The individual could notify the bank that they're going to sell the property, and the bank might cool off. They might say, okay, we're going to give you one more month if you're actually proving to us that you are trying to sell this house. Again, creative financing, there's a lot of gray area that you can move around in and help that person prevent the foreclosure from happening and prevent the bank from having to take possession of the property and then all the fees. So that's a possibility. It might happen. Now, during the actual foreclosure at the courthouse, you have to put in the deposit for the property there. Each courthouse probably has different requirements as far as the down payment or the deposit. As soon as you win the bid, the few that I've purchased, we had to immediately give around $5,000. And then it was just a matter of the legal things being completed for the bank to take possession or the bidder to take possession. So once that is en route, then it's very difficult for a traditional lender to operate within those time constraints and get you that loan from the beginning. Now, in the third process, when you have access to the interior and you have time frame, if you're actually working with a realtor that the bank has contracted with to sell the bank-owned property, or if you're working with a realtor that is approved to do business with HUD, then there might be enough time frame to actually get traditional financing on that bank-owned or HUD property. The other ways that you can go about financing your foreclosure is you can do cash. Now, this one's pretty simple. I don't have to say much about cash. You take money out of your pocket and you give it to the owner and you walk away with the property. This is my favorite method because it's quick, it's easy, there's a lot of speed behind it, and people really appreciate speed, especially distressed owners or banks, which are arguably distressed owners. When I buy a property in cash, what I do is I get the property stable, I make sure I have interior access, I make sure I fix everything, and after that, then I will approach a bank and attempt to refinance that property and get it on a long-term, low interest rate mortgage. The second thing you could do is use hard money. And arguably the third thing that you could do is private money. Now, hard money is kind of like a lender. They are an institution, an individual, someone that has access to capital that might not necessarily be theirs, and they're willing to give it to you. When I say hard money, the way I differentiate between these two is hard money, they charge origination fees, they charge points. A point is 1%, so if you do a $100,000 loan, 1 point would be $1,000. So the hard money lenders that I'm aware of, they charge anywhere between 1 and 5 points. So you could, in order to get the money to buy the foreclosure, you might pay anywhere between $1,000 and $5,000 to use that money. When I say private money, what I mean is like a friend, a family, somebody that knows you, understands the business that you're in, and they're willing to just give you the money. So if a property costs $100,000, they will give you $100,000 at a predetermined interest rate. In my explanation, in my view of it, private money is cheaper. Now, both of these people may have conditions if it's a foreclosure and nobody really knows what the inside looks like, because the last thing you want to do is take money from a friend and family and just have kind of a Russian roulette thing going on of what's behind the front door. The property that I had no idea it was going to cost $40,000 to fix it up. Fortunately, we had the cash available to actually rehab that property to get it to a nice place to live, but that might not be the case for you. So I would say most certainly do your due diligence as much as possible. I know you're not supposed to trespass, but if you are able to get away, if it's vacant and you think you have the ability to not trespass, but see inside the windows to figure out what exactly you're working with. Again, even if you can see inside the windows, what you're able to see is very limited. It's not a good representation or accurate of how much work is needed. So when you're playing in the foreclosure arena, just make sure that you are prepared for the worst and you have enough capital to completely redo everything. Before I recorded this video, I actually reached out to a hard money lender and I asked him what his expectations or rules regarding foreclosed homes are. He said that whenever he is lending on a foreclosed home, he is going to assume that the property needs everything on the inside. If you have a good exterior picture, then we could assess the exterior from that point to see if anything is needed to account for a new roof, new paint, anything along those lines. But as far as the interior goes, since nobody knows what it looks like, he's going to budget everything. So let's say the property is a $200,000 home. This is the exact example that he gave me. $200,000 home, he's willing to do 70% of the after repair value, which would take you to $140,000. So if everything were perfect on this property, then he would lend you $140,000 for the purchase price plus the rehab. However, assuming that it needs everything, let's say a complete interior gut conservatively will be 40 grand, then now you have $100,000 left for the purchase price. So if you're financing $100,000 for the purchase price and the fee is 5 points for doing the loan, then you're looking at the $5,000. Not to mention, you still need to put the 25% down on that loan. So that's going to be $30,000 out of pocket. Does that make sense? I hope that helps. So that's the rundown of how you can finance a foreclosed property. So if you haven't already, please go back and watch the how to find and buy foreclosed homes video. And again, this video came from you guys asking me questions and follow-ups about the videos that I'm posting. So I really appreciate that. Keep the questions coming. Thank you guys. Can't wait to talk to you soon. Thanks. And happy Friday, if it's still Friday when you're watching this. Otherwise, I hope you have a great weekend or just a great day on whenever it is that you're watching this. Okay, thanks.